Assalamualaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Dadan Firmansyah, with NPM 23,411,076, from the Management 23X class. Today, I will be presenting on the subject of financial management with the title Ratio Analysis in Finance. Ratio analysis is a critical tool in financial management that allows us to assess a company's performance and stability by comparing various financial figures. This analysis enables stakeholders to make well-informed decisions about the company's financial condition, and it is essential for investors, creditors, and management. In this presentation, I will cover the main categories of ratios used in financial analysis, along with their calculation, interpretation, and application. Here's an outline of what we will discuss. Liquidity ratios. These ratios, such as the current ratio and quick ratio, are crucial for measuring the company's ability to pay off short-term liabilities with its available assets. High liquidity ratios indicate a solid position to cover current obligations, essential for maintaining operational stability. Example: a current ratio of 2:1 indicates that the company has twice as many assets as liabilities, suggesting it can comfortably meet short-term debt. Profitability ratios. These ratios include the gross profit margin, net profit margin, return on assets, ROA, and return on equity, ROE. Profitability ratios reveal how effectively a company generates income relative to its sales, assets, and shareholders' equity, reflecting its capacity to create value for shareholders. Example: an ROE of 15% shows that for every dollar of equity, the company returns 15 cents in profit, indicating effective use of shareholder funds. Efficiency ratios. Also known as activity ratios, like inventory turnover, accounts receivable turnover, and asset turnover. These ratios measure how efficiently a company uses its resources to generate sales. High efficiency can point to optimized asset usage, while low efficiency may indicate areas for improvement. Example: a high inventory turnover ratio suggests that the company quickly sells its inventory, reducing storage costs and increasing cash flow. Solvency ratios. Solvency ratios, such as the debt-to-equity ratio and interest coverage ratio, examine the company's ability to meet long-term debts and assess financial risk. They provide insight into the company's capital structure and whether it relies more on debt or equity. Example: a high debt-to-equity ratio may signal higher financial risk, as the company is more reliant on borrowed funds, which could affect stability if revenues decline. Market ratios. Ratios like the price-to-earnings (P/E) ratio, earnings per share (EPS), and dividend yield help in evaluating the company's performance from an investment perspective. They indicate how the market values the company's earnings and can be helpful for investment comparisons within the industry. Example: a low P/E ratio might suggest that the stock is undervalued, while a high EPS indicates strong profitability on a per-share basis, which could attract investors. Comparative analysis and benchmarking. To gain deeper insights, it's important to compare these ratios over time, trend analysis, and against industry peers. This helps identify growth patterns, operational improvements, or areas where the company may be lagging. Example: comparing a company's profit margin to industry averages reveals whether it is outperforming competitors in generating profit from its sales. Limitations of ratio analysis. While ratio analysis provides valuable insights, it also has limitations, such as dependence on historical data, potential for different accounting practices, and influence from market conditions that may distort the true picture. Example: seasonal businesses may show fluctuating liquidity ratios depending on their cycle, which could be misleading if not adjusted for. Through this analysis, we'll gain a holistic view of a company's financial health, uncover trends, and better understand its ability to sustain operations, generate profits, and grow over time. I will illustrate these concepts with real-life examples and cases to show how ratio analysis applies in practical financial decision-making. Let's dive into each category in detail to fully understand how these ratios contribute to a comprehensive financial analysis.